Your financial life is going fine until you get that envelope, the one with the IRS logo in the corner, and suddenly every decision you've ever made feels like a crime. We're talking audits, asset exposure, and the very real possibility that what you built could be quietly dismantled by a process most people never see coming. Every year, tens of thousands of Americans get selected for audits. And the ones who suffer most aren't the ones who cheated, they're the ones who are simply unprepared. The IRS pulled in over $30 billion in additional assessments last year alone, and a huge chunk of that came from people who just didn't know how to protect themselves. Think of your assets like a house with no locks, technically yours, but wide open to whoever shows up with the right paperwork. The audit process is less about catching criminals and more about finding the gaps between what you reported and what the system expects to see. Here's the first thing most people get wrong. They think an audit means they did something illegal, so they panic and start moving money around right after receiving notice. That is the worst possible move, because restructuring assets after an audit begins can look like obstruction and actually creates new exposure where there was none before. The very first step, and we mean within the first 48 hours, is to stop touching everything and call a tax attorney, not just your accountant. A CPA prepares your return, but an attorney carries attorney-client privilege, which means your conversations are legally protected in ways that your accountant's notes simply are not. Once you have representation, the next move is to build a clean paper trail of everything you own, every entity, every account, and every transaction tied to the years under review. You want to be the most organized person in that room, because the IRS responds to documentation the way a fire responds to oxygen. More of it means more scrutiny, but none of it means you're already losing. There's a persistent myth that hiding assets in an LLC automatically shields you from the IRS, and we need to put that one down right now. LLCs and trusts are legitimate tools, but they only protect you if they were set up correctly, funded properly, and operated as real, separate entities, not just paper shells you created last Tuesday. One of the smartest things you can do before or during an audit is ensure your business and personal finances have never, not once, shared the same bank account. The moment you pay a personal grocery bill from your business account, you've handed an auditor a thread they are professionally trained to pull. History shows us that audit outcomes are largely determined not by guilt, but by how well documented and cooperative a taxpayer appears. The people who come in with organized binders, clear reconciliations, and a calm representative almost always fare better than those who come in defensive, incomplete, and reactive. Real estate investors specifically need to double-check their depreciation schedules, cost segregation studies, and material participation records right now, because these are the three areas where auditors find the most leverage. If you've been claiming losses aggressively without the paperwork to back up your active participation, that's a liability sitting in plain sight. The irony of tax law is that the same strategies the wealthy use openly trusts, holding companies, charitable vehicles are available to everyday investors, but most people never use them because they assume it's only for the ultra-rich. You don't need $100 million to benefit from proper entity structuring. You need a plan and a professional who actually understands asset protection, not just tax prep. When the dust settles, what separates the people who walk away clean from those who don't is almost never intelligence, or even the quality of their accountant. It's process, documentation, and the discipline to stay organized before there's ever a reason to be. The audit is just the test. Your record keeping is the answer sheet you've been filling out for years. Discipline and consistency in how you structure, document, and separate your financial life will protect you far more than any single clever strategy ever could. Be calm, be organized, be represented, and trust the process. Because the goal isn't to win an argument with the IRS. It's to never give them one to begin with. And if you're ready to start building the kind of financial foundation that holds up under scrutiny, whether that's through real estate investing, contracting projects, or connecting with the right lenders, check out our links in the description below.